Hi guys, so just going to give you a quick rundown of some of the functionality we've built on the Hedge platform so far. And again, just a reminder, the aim of this information is to help CFOs and treasury managers make decisions, assess their exposure, get a handle on where they're exposed, what the potential level of risk is, help them make decisions around that exposure in terms of selecting the appropriate product or strategy to manage that exposure. And then if they have a hedging policy and they execute a hedging program, making sure that program remains within their hedging policy and reporting on it on an ongoing basis. So I'll start with the basics. Data input. Look, most of this information for mid-sized corporates in terms of forecast, etc., still lives in spreadsheets. So our big focus initially has been taking information in from Excel. So we built some kind of drag and drop with pretty sensible kind of data parsing and validation to make it as easy as possible for the client. But a big priority for us, and we're making good progress with some potential providers, is plugging into bank account APIs to give visibility of cash balances, because that's really where most treasury managers start this analysis, and also plugging into the likes of Xero and QuickBooks, so the accounting packages that kind of smaller and mid-sized companies use, so we can access more of their financial data. So once you have a data in there, you can save a scenario, and you can choose a scenario if you've more than one scenario saved. This example has a range of FX, commodity, and coffee exposure. You select your reporting currency, and you can revalue that whenever you want. It goes off, pulls in the market data, and produces mark-to-market value for you for the whole portfolio, and then broken down by each exposure, and also broken down by each of your bank counterparties, which we will build into a forecasting tool for margin calls, and again, with the aim of assisting liquidity forecasting. Also gives a breakdown, again, aimed at liquidity forecasting, when your exposures are coming off, are they in or out of the money, will that be a cash flow out or a cash flow in, etc., which again is very useful for liquidity forecasting. Anything on any of these pages you see that has a tick box, that's to include it in our treasury reporting functionality. And again, that just drags all that information in. You can create your own reports using these templates and run them on a periodic basis, or schedule them to run automatically. So you have your valuations. Next one is your exposure summary. Again, you pick your scenario, your currency pair, and you generate your summary. That looks at your overall exposures, your breakdown by asset class or type, more specifically to the underlyings, your exact notional exposure by currency pair, Brent crude oil to coffee, whatever it is. And then it brings in your hedged notional of your trades and shows you how much of your forecasted exposure is actually hedged. So in this case, our hedge ratio is 54%. Obviously, you get a bit worried if you're over hedged, but that is said, it only gives a limited picture of what your actual risk and risk management is doing. A bit more detailed view gives a breakdown of your VAR, your value at risk. So this 226 million of exposure, 95th worst case per percentile move is a negative valuation of 18.8 million. When you bring into account the hedges, that reduces to 12 million. So even though we have 54% of our exposure hedged, the risk reduction is more like 30%. So that's dependent on the volatility, what's been hedged, and it again gives a better reflection of what a company's exposures are and how effective their current hedging is. And again, we have risk appetite and capacity. Customer can choose what their most important factors are, how they manage their risk. In this case, they're looking at EBITDA. What does that value at risk number mean to that? So if they have an EBITDA of 10 million, their 95th worst case move happened. all of a sudden all of their EBITDA has been wiped out. So again, probably not a number they're going to be comfortable with. Then looks in more detail at their forecasted exposure by each currency pair or asset class, whether that is a contracted, um, forecasted, or expected exposure, and then how much of that is currently hedged or unhedged, and then a little bit more information about each, the value at risk associated with each one, so you can see what you're actually uh, your your real volatility or your real risk. It may not be your largest exposure, but more so your most volatile exposure, and also the price performance of each recently. So obviously we've seen huge volatility in crude oil, also in coffee, so they might be the more volatile exposures that are worth paying attention to. And then we have this, which we call our exposure significance ranking. It looks probably not a big deal for someone who only has six exposures to keep on top of, even if they have a small team. But when you start dealing with multiple currency pairs or many multiple currency pairs, different interest rate exposures in different currencies, different commodity exposures, I suppose this is designed to help them keep on top of what their biggest priorities are to manage at a certain moment in time. And it doesn't just look at what your biggest exposures are. So we have a weighting, but again, customer could design this themselves. It takes into account the notional, the unhedged notional, the value at risk, unhedged notional for trades coming up to maturity immediately, which could cause a liquidity problem. Um, and then what exposures are actually contracted versus maybe less certain forecasted or expected exposures, which exposures moved the most in the last 3 months, etc. So combines all those, gives each of them a score and ranks them. And again, if you are a CFO who doesn't have a lot of time to be looking at this, gives them a quick view to show where they should prioritize their time and attention. And then again, obviously all reportable and easy to automate. And then if you want to dig down into a specific exposure, you have your exposure analysis page. Again, pick your reporting currency, pick any of your exposures, and then that generates a more detailed summary of your exposure, what's contracted, what's forecasted, what's expected, your current hedges, if you do have potential hedges that you're looking at, and then your unhedged position. It takes into account the current spot rate, your average hedged rate from your hedging trades, and then what your hedge ratio is for that underlying. And then it also breaks it down by maturity date. And importantly, if you do have a hedging policy, it brings your hedging policy in graphically represented. So in this case, you might be 60 to 80% hedged for the first 3 months, 40 to 6%, etc. And it shows whether your current trades are within that band, and also if you're thinking of adding potential trades, whether they are in that band as well. And if you are breaching, it will show you, give you a breakdown of where you are in breach and what you need to do to remedy that. So that's the overview of the exposure and the valuations. Next, we will move on to the more detailed risk analysis.